and regulatory enhancement alignment. Hence, I think that our focus on interoperability at this side event is especially relevant today. Second, I must acknowledge that significant progress has been made since 2020, thanks to the efforts of the Financial Stability Board, the Committee on Payments and Market Infrastructures under the leadership of Governor Panetta, international organizations and private sector in meeting the 2027 targets of the G20 roadmap to enhance cross-border payments. Currently, several important initiatives are underway, but just on the towards the end of June, we received the good news that FATF has released a revised recommendation 16 on standards for data in cross-border payments. There are ongoing efforts to harmonize regulatory, supervisory, and oversight frameworks, and the latest 2025 key performance indicators used to assess our annual progress towards meeting the goals outlined in the roadmap for wholesale, retail, and remittance cross-border payments, and a call from the South African Reserve Bank and CPMI for papers on opportunities and challenges in advancing cross-border payments. And of course, regular monitoring surveys in cross-border payments from CPMI and the FSB, and CPMI's current work on application programming interface. I commend and fully support these initiatives. However, as we approach 2027, we need to consider how to ensure these efforts are coordinated so that the practical outcomes help us in achieving our targets. I'm also encouraged that enhancing trust in cross-border payments is a key theme of Tech Sprint 2025. Third and last, that what does the data tell us? The 2024 roadmap's KPIs indicated that the cost of both wholesale and retail cross-border payments for sub-Saharan Africa remains high and the speed of transacting relatively slow. In fact, sub-Saharan Africa, along with a few other regions, is furthest from the 1% cost target, with an average transaction cost of 3.7%, and some payment corridors exceed 10%. Well, addressing the challenge may require a candid review of our approach and policy options. Clearly, much remains to be done, and I look forward to hearing your perspectives on how we can unlock the power of data, interoperability, and trust to move the sub-Saharan Africa region forward. I now hand over back to you, Chair, with a budget surplus of 20 seconds.
Thank you very much to the Governor and the Deputy Governor for also inviting us, the BS Committee on Payments and Market Infrastructure, to co-organize this session on cross-border payments. And it's truly an honor to moderate this outstanding panel of experts that we have here, and also to do it in front of such an distinguished audience. When driving from Durban to Zimbabwe earlier today, I saw a lot of cargo ships on the horizon. All of them were heading towards the Durban port. And our driver told us that, in fact, the port of Durban is one of the busiest and one of the largest ports on the entire continent. And it operates 24 hours a day, 7 days a week, 365 days a year. So that's also how modern fast payment systems are operating. The port of Durban is also interoperable or interconnected to all the other major ports on the globe, thanks to standardized containers. And this is something that we are trying to achieve in the payments domain, and thanks to ISO 20022 application programming interfaces, but also the interlinking of fast payment systems, we are slowly, but hopefully surely, getting there to get this interconnectivity. The point here is that also containerization itself and the standardized containers also facilitate the monitoring and measuring of cargo flows. And this exactly brings us to the topic of today's panel, where we want to get some additional insights into both the payment flows in sub-Saharan Africa, but also particular initiatives that we can try to build on in improving cross-border payments within sub-Saharan Africa and possibly even beyond. Beyond global monitoring, also understanding region-specific challenges is crucial. And to this end, the G20 South African presidency, the South African Reserve Bank, and the BS CPMI have called for papers to explore cross-border payment opportunities and challenges in sub-Saharan Africa. And we've received an overwhelming response rate of around 50 submissions, which are currently being reviewed. And the submissions have been from academics, from researchers, central banks. They have been from the industry and associations. But the selection of best papers will be presented at a conference later this year. But the good news is that we don't have to wait that long. So we can already dive into the discussion with the experts of today's panel. So without further ado, let me introduce the panelists. And I'm really honored to have them discussing with me today. I'll start the furthest to my right with Tommaso Mancini-Grifoli, who is the Division Chief of Payments, Currencies and Infrastructure Division at the IMF. Prior to joining the IMF, he worked for the Swiss National Bank and has extensive private sector experience, among others, in the with Silicon Valley companies and also major financial institutions. Then we have Sabine Mensah, who is the Deputy Chief Executive Officer of Africanenda and overseeing their policy, advocacy, capacity building and partnership efforts. Prior to joining Africanenda, Sabine worked for the UN Capital Development Fund, UNCDF. We have Brendan Pierce, who is the Chief Executive Officer of Finmark Trust. Brendan leads the strategic direction and operations of the organization, and he previously served as an advisor to the Managing Director of the Land and Agricultural Bank of South Africa and held several senior level positions in the public and private sector. And last but definitely not least, we have Maxine Schlaver. Maxine joined the SADC Banking Association more than 10 years ago, in April 2014, and is heading up the association as Executive Secretary. She previously worked for the South African Reserve Bank in various capacities over a period of 15 years. Thank you very much for joining me today, and let's go straight into the discussion. And we've heard that enhancing cross-border payments by the governor critically depends on improvements in the domestic and regional payment infrastructures. There are many promising developments that we are seeing in sub-Saharan Africa across the entire segments of remittances, retail payments, and wholesale payments. And I know Sabine is monitoring it not only in sub-Saharan Africa, but across the entire continent. So Sabine, Africanenda tracks the progress of fast, or as some refer to it, instant payments on the continent. So where do we stand? Will we have universal adoption of fast payments anytime soon? And what is your perspective on the potential of regional payment systems?
Thank you very much, Thomas, and I'd like to thank the organizer for the opportunity to be here and present on behalf of Africanenda Foundation. So as you know, Thomas, every year we map out the landscape of instant payment system in Africa. And what is the data telling us? There are 31 systems live currently in Africa. 28 of those are domestic systems at a country level, and 3 are regional systems. Now, these systems collectively enable access to IPS capability in 26 countries for now on the continent. There also, the data tells us is that there's been a lot of progress. In 2001, there were only 3 instant payment systems versus 31 today. There are also 3 regional systems that are already enabling cross-border payments to some level, particularly in Central Africa with GMAC Pay, in Southern Africa with TCIB, and I'm sure Maxine will talk about that, and in the Pan-African level with PAPS. Now, what's really encouraging is that inclusivity of these payment systems has improved. And when we're talking about inclusivity, what we mean is that these systems are enabling broader use cases. They're enabling a diversity of channel and instrument. And they're also enabling banks and non-banks to compete for a share of wallet of consumers. And that is great progress for us as we look at moving forward into the ecosystem. Now, to your question about adoption or universal access, I would say the momentum towards adoption of instant payment system is definitely growing. In addition to the 26 countries where the systems are live today, 27 other countries have expressed that they're working on their instant payment system at diverse levels of development. In addition to that, there are 4 additional regional systems in the works, actually. One in the West Africa Economic and Monetary Union, WAEMU, another one in the Economic Community of West African States, ECOWAS, another one in East African Community, the EAC, and another one in the COMESA, the Common Market for Eastern and Southern Africa. So if all the planned country development and regional system come together, it's definitely within grasp for us to have universal access to IPS in Africa. And I have to tell you, for Africa NENDA, our vision is every single country having access to an IPS by 2030. So the real question is, by when can we accelerate this movement? And I want to let you know that our team at Africa NENDA of 24 experts across 13 countries are available to all, central banks and government agencies in Africa to really provide technical assistance, capacity building, and work together with the different stakeholders in this room and outside to make sure that we are really accelerating our momentum towards these inclusive instant payment systems, because they are, and they will provide a landscape for enabling cross-border payments, enabling interoperability across the continent, as you mentioned, Governor, and ensuring that we are really offering services at a lower cost, enabling consumers to, tap into the digital future where we sit in. So thank you very much.
Well, thank you very much, Sabine. These are quite impressive figures, and in fact, it seems likely that the African continent might be the first one who has kind of universal adoption of fast payment systems in foreseeable future. And you mentioned also one of the systems that is TSIP, or transaction cleared on an immediate basis, which I think is the fast payment scheme or fast payment systems in SADC, and it's kind of complemented on the wholesale side with SADC RTGS. So can you elaborate a bit more, Maxine, what corridors does they currently cover? What currency do these systems feature? And are they possibly already on ISO 20 or 22?
Thank you very much, Thomas, and thank you for the invitation. The TCIB has 8 participants, and we are seeing ourselves today in about 6 corridors. And have cleared today over 323 million rand. Is it compliant? Yes. The initial start, when we started the work on the TCIB, we said it had to be ISO 2022 compliant, so that was a plus. From a currency point, we're using the rand for now. We are going to leverage off the RTGS when they add on more currencies, then you'll probably see more currencies within the TCIB, but today, currently, the rand only. In terms of the SADC RTGS, yes, 2022 compliant as well. We went live last year in June, I think the 10th of June, so a plus for us as well on that. That is live in 15 countries, so SADC, all the SADC members. We've got about 87 banks, which includes some central banks who are participants on that. And from a clearing point, we've cleared over 17 trillion rand. Currently today, dominant currency is the rand, but we are seeing work being conducted by the RTGS to bring in other currencies. To date, we're aware of the Kwanza, and possibly some work around the US dollar as well. Thank you.
Thank you very much, Maxine. And both systems launched quite recently, if I may say so. But I think, Brandon, you are kind of looking into the efficiency of cross-border payments for quite some time now in the SADC region. So based on your research in the SADC payment corridors, what progress do you see when it comes to the efficiency of cross-border payments? And can you share some of those insights that you have researched?
Sure, thank you. Thanks, Thomas. And thanks for having us here. This is a great opportunity. We've been working, as you say, in this cross-border market for more than 10 years. We're showing our age, all of us now. So we've seen the good, the bad, and the ugly over that 10 years, and we've worked very closely with Reserve Bank As I say, our focus is on the South Africa out corridors because that's where the money is flowing. It's the biggest corridor, inter-Africa corridor on the continent. And I think one of the key learnings there is also that each remittance corridor is different. It has different peculiarities. And within SADC, you have so many different corridors from South Africa out, and each of them, are different. I think it's the largest corridor, and it follows the remittance, the stock of migrants in South Africa, which we estimate to be close to 4 million migrants, people from neighboring countries who come into South Africa and send money home. There's not an exact figure because there's still quite a big informal market. Estimates from our stats SA put it lower, 2.5 million. I think that's wrong. And some political parties put it at 15 million. I think that's wrong as well. So I think we are closer to about 4 million, and that's what we base our research on. So over the last decade, as I say, we've worked closely with the Reserve Bank to look at what are the blockages, what are these volumes, and how do we get costs down. When we started this 10 years ago, the average cost price to send was more than 20%, the cost per transaction. It could take, that was kind of formal and informal, and it was mostly banks playing in the space. There were no non-banks in the space at the time. And so a lot of the work that we needed to do was to create more competition, and with the FinServ department passed lots of regulation and opened up the licensing categories to have non-banks playing in the space, and I think they've changed the game. So quite a lot has happened over the while. When we started also, 80% of these remittances were informal. Only 20% of it was formal. And today what we've seen is a complete change. Today we have almost 80% formal remittances, and driven largely by COVID. So COVID is very negative impacts, but in this space it had some positive impacts. The formal remittance market went from about 6 billion annually to about 20 billion now. And I'm quoting from research we've just completed. We do this market study every 2 or 3 years with the Reserve Bank, and this market study the data was collected this year, so it's quite fresh data. So there's been this complete swing. When we saw the swing happening during COVID, we thought that after borders are open, people may relapse and go back to informal. But that hasn't happened for a large part. In some corridors, yes, it has happened, like South Africa to Malawi, and that's because of the currency crisis in Malawi. People, because they want a currency that has some value, they move to the informal sector. This change has been remarkable. To change from 80% informal to 80% formal has been remarkable. I should also say, and just to say something about data as well, when we started this work 10, 12 years ago, there's very little data. We have to thumbsuck quite a lot, whereas now we have a lot more reliable data. The Reserve Bank data that they collect is a lot more reliable. We have a better handle on the number of migrants in the country, so we can estimate better what the informal market still looks like. I'm just going to go through the key ones, Thomas. I see you looking at me very worried that I'm going to take too much time. In terms of pricing, pricing has been coming down. As I said, it started over 20%. 10 years ago, as an average, we are closer to 8% at the moment per transaction. I must just say, this is where our estimates and work differ to how the World Bank measures it. The World Bank measures a price point of $200 and $500. Our research tells us it's closer to $55 actual transactions that are remitted. So our average transactions between 500 and about 1,500 Rand. Those are the average transactions. By the way, those are also coming down and reducing, which means that these are not rich people. These are poor people sending money home, and the non-bank players have innovated and allowed a lot more to come in. I must just say about the change from COVID, one of the positive things that happened 2 years before COVID is the risk-based approach that was introduced in South Africa. If you recall, the FICA Act was changed, and the Reserve Bank adopted that. If that didn't happen, the remittance market would have collapsed in 2020 because people would not, informal market would not be able to send people home, as send their money home. As I say, the market share, so just back to pricing, so about 8%, and again, what we try to do is to do weighted averages when we look at this pricing. 4 countries receive more than 90% of the 25 billion that goes annually from South Africa. Lesotho, Mozambique, Zimbabwe, Malawi. Those 4 countries cater for 90% of the remittances, and so we weight this data to make sure that we're not taking into account corridors that actually have very little. We also weight it by the institutions that send, so between banks and non-banks. Non-banks have captured this market completely. I'm not sure banks are still interested in this market at all. In fact, it may be controversial, but the only contribution they're making is pushing the average prices up. So there is a red flag, though, I think, in the space. I think for regulators, I'm glad the governors are here, is within the CMA. CMA used to be the cheapest cross-border markets, corridors. The prices have gone up substantially over this last period, and largely because of the change in regulation. We think it's the change in regulation of stopping banks from reporting those transactions as on-us transactions, but they now have to report them as cross-border transactions. So the increased administration, this is what we think is responsible for this. But I think the result here is contrary to what the Reserve Bank intended with it. And so we've picked that up in this data. So Lesotho, Namibia, and one other country, those prices have gone up substantially. By the way, those corridors still have banks playing quite a big role, and so that's coming through. As I said, Malawi is an outlier because of the currency issues and problems there. But I think substantial progress has been made in terms of costing. If you consider that if you take the cheapest products across border, if you take the 3 cheapest for each corridor, the pricing we come down to is around 5%, which is much closer to where we want to be. And I've always found this average pricing a bit of a misnomer. I understand why it's done, because you need to be able to compare globally. But the issue is that if the poor have access to cheaper products and they're using them, surely that's what we should be aiming for. And I think in this SADC market, I think we've achieved that. Some of them are in the region of 3%, the lowest that you have. So I will not talk about I think one of the key for us, our analysis, and it may come as another question, but is the issue about cash. That this market is still 90% cash in, as opposed to, if you look at other markets, digital cross-border transactions are the mainstay. In these corridors, it's still people going with their cash to an agent and to transfer. So I guess it's a bit of a hybrid. It's cash in the first mile, it's digital in the middle mile, and then it's cash in the last mile as well. So I think, but I'm sure Thomas will come to those questions later. I'll leave it there. Thanks.
Thanks very much, Brendan, and some I think provoking thoughts and comments. I think one other aspect I'd be keen to hear is also from Tommaso. So the IMF engages with many central banks and private sector stakeholders as part of your country diagnostics and also your technical assistance work. So how does the feedback that you're receiving also compare to some of these global averages that Brendan just referred to?
Thank you so much. It's a great pleasure to be here and to engage with this distinguished audience. Many friends in the audience, many people from whom I have learned a lot in discussions, and I look forward to continuing. So the question is really about aggregate data versus knowledge from the field. And both are important. Aggregate data tells us whether there's a problem. So average costs of remittances in sub-Saharan Africa, 9%. There is a problem. But of course, these aggregate numbers hide a more complex reality. A lot of heterogeneity. Heterogeneity in the means of payments. So you send remittances through e-money, 4%. You send a bank wire, 20%. A lot of heterogeneity also in corridors. South Africa, Zimbabwe, above 10%. South Africa, Lesotho, about 3%. So it's important to look at the more granular numbers. But of course, this is still just an issue of problems. So how do we fix these problems? How do we go beyond? Well, then it's important to do these diagnostics that we do at the IMF. And the diagnostics will answer questions such as, what is driving these costs? Is it customer onboarding costs? Is it FX? Is it rather the lack of competition? Let me give you just two examples that illustrate these types of diagnostics that we do in countries. So the first example is back to the South Africa-Zimbabwe corridor, which we said was very expensive. Why? So we looked a little bit at this corridor along with central banks and found out that about 70% of the flows go through just two providers. And that contributes in a big way to these high costs. And so, of course, the technical assistance that we do afterwards focuses on introducing more competition in this market, greater access to non-banks in order to drive down the costs. That's example number one. Example number two is a region with a perfectly functioning, very operational regional payment platform. Very cheap to use, etc., but nobody uses it. And again, and instead people use more expensive means. So again, why? What does the diagnostics tell us? So diagnostics tell us that the issues are about awareness. Payment service providers not knowing about the existence of this regional system, not knowing how to connect. The problem is about uneven regulatory frameworks between countries. The problem is simply about coordination failures, each provider not wanting to pay the fixed cost to connect before others do the same. So our technical assistance there focuses on just these issues. So increasing awareness, so payment providers know about the system, improving regulatory reforms, so service providers can connect, and then bringing providers together in order to solve the coordination issues so that they want to connect. So I think the bottom line is that aggregate data is important. It shows us where the problem is. But in order to provide good policy solutions, we need to go down to diagnostics, to the information we get only in the field.
Thank you very much, Tommaso. And to raise the awareness, and the figure that you, Brandon, mentioned is still haunting me. There's 90% of remittances that are initiated in cash. So that's kind of counterintuitive because according to some of the data, of course, cash remittances are among the most expensive ones. So why does cash still dominate the first mile? And as you said, also the last mile. And what are the implications? And kind of most importantly, how can remittances become more digital, I guess, and also in that sense, lowering cost?
Yeah, so I think the work that we've done points us to, and the engagements we've had with financial service providers that are operating in this market is that it's the cash handling that increases the cost for them, cash in and cash out. The networks that they have to, the agent networks they have to put up, handling cash, the risk to it. In some countries, I'm not sure we can do much about them. They're flying dollars and rands from South Africa into those countries because there's no currency on the other side. But the issue about, and I think if we can digitize the first mile so people don't have to keep cashing, that is what's going to bring the cost down. And in South Africa, that's a regulatory issue, that non-banks are not able to provide a store of value without a sponsoring bank. And so that's the discussion the Reserve Bank is taking at the moment, and the Reserve Bank has developed a draft exemption to the Banks Act to allow and enable non-banks to play in the space, to provide a store of value on their own, so that you can't transact digitally if you don't have a store of value. And so that's where the key issue is sitting. For us, that is the game changer for the cross-border remittance pricing, but also for improving and expanding domestic digital payments in township and rural areas. Those players that are a lot more agile, non-banks, the fintechs, I think those are I'm not bashing banks here, please. She's looking at me as though I'm bashing her constituency. But banks have just not come to this party, and they're not just structured and set up to service this market. And so for me, that's the key issue. I think the Reserve Bank has already taken the steps to move in that direction, because there is an acknowledgement that that is one of the key remaining challenges. Of course, there are other key remaining challenges, issues about AML, onboarding. As I said, the 4 million, about 85% of those migrants are undocumented migrants. They are not legally in South Africa. And so the issues around AML become quite big and increases cost for financial service providers to onboard them. There are some of those issues remaining, and there's work being done by the CCPG on it as well. But I think this issue about cash in the first mile especially, but cash in that last mile as well, is, I think, key to driving up and keeping costs high. Thanks, Thomas.
Thanks so much, Brendan. And you mentioned banks quite a bit. I have to give the floor now to Maxine to say, well, the SADC Banking Association, of course, has a broad mandate, but also membership. So how do you support your members to improve the payments landscape, and how do you also track progress, just to address some of the points that have been raised?
Thank you, Thomas. So I just thought I should add, you made a comment earlier, that it's important to note that the SADC RTGS has been in place and running for about 12 years, went live in 2013. The TCIB went live in 2021. So I think the RTGS has been around a bit longer. In terms of support to the banks, we provide a lot of training, and we find that's the best way to actually track what's going on. I think in general, across the region, you find that the banks are agile, and sometimes we need to exclude South Africa because a country as South Africa is I think, a bit more advanced than our other counterparts. But in general, the banks are agile. We found that with our work, especially when we were connecting to the SADC RTGS, it provided the banks an opportunity in the region to actually upgrade a lot of their systems. If they were going to play in the space and going to be available as a service to those in the region. And from a monitoring point, we find training is the best, actually. It's through the training, and especially the one-on-one training in country. We find that you get more from a communication from the banks themselves. Where they are struggling, then you're then able to intervene and provide them with the necessary tools to be able to work in their environment. Yeah.
Okay, thanks a lot. Tommaso, are there any concrete projects the IMF is currently working on to really kind of improve the payments within the region itself, and how can they and will they hopefully improve cross-border payments?
Right, so the IMF's technical assistance work. I think it's appropriate to pitch this work relative to the G20. We're here at the G20 meetings, and the G20 roadmap shows up very prominently. The roadmap kind of culminates in a series of targets that the community hopes will be hit in terms of cost, speed, transparency of cross-border payments. In order to hit these targets, there needs to be implementation on the ground. In order to implement on the ground, often technical assistance from the IMF and World Bank can help. And that's where we come in. Our technical assistance covers a broad terrain, a broad suite of products, really, going from the more general to the more specific. On the more general side, our analytical work, just bringing case studies to the attention of policymakers, helping countries share lessons, seems to be very useful, very important. We just published a paper a few weeks ago on digital payment innovations in sub-Saharan Africa. Number two, training and workshops. So this is where we bring countries together to improve awareness, really, of the challenges and the solutions that exist. We ran one in Ghana in March of this year with about 22 central banks from sub-Saharan Africa, focused on cross-border payments with the themes of interoperability and legal reforms. So that's number two, training and workshops. Number three is peer learning opportunities. So there's a huge amount of insights and lessons sitting in central banks, but not enough time to share this. So the IMF can help by convening central banks and allowing them to share, inviting them to share lessons. We do this at the spring and annual meetings, for instance, with central bank governors from sub-Saharan Africa. And this has proven to be very successful, very useful. And then, of course, fourth is our classic TA, where we go in the field, we work with countries on technical issues. We work with them to prepare, to build, and to evolve. And prepare really means improving domestic payments. Building can be building solutions specific to cross-border, such as interlinking. Evolve is about future-proofing the cross-border payments, exploring topics like CBDC and tokenization. We spend most of our time in preparing. And that's really because we believe that 80% of solving the cross-border payment problem is solving the domestic payment problem. If you think about interlinking fast payment systems, it will not work unless the domestic fast payment system is up to par, unless it is supported by clear regulations and legal frameworks. And only then can fast payment systems be linked. There's an important work by the CPMI that suggests that only about a third to a half of fast payment systems are ready to be interlinked. And so a lot of the work needs to be done upstream in improving domestic payments. And that's where we come in. To give you a concrete example, I think the best example is the work we're doing with the World Bank in the SADC region. This is technical assistance work focused on diagnostics, on upgrading regulatory and legal frameworks, and on expanding access to non-banks. And this is work that is very much supported by the governors of SADC. We report to them every 6 months. It's work where we get guidance from the countries and from governors. We work very closely with the SADC subcommittee on payments. So it doesn't get a lot better than this. This is the most productive type of technical assistance that we can do, thanks to the very strong buy-in, and I think thanks to the very strong leadership of Governor Kganyago. This is important because hopefully we'll be able to show concrete gains in this region, and these gains will incite other regions to reach out and engage in the same type of technical assistance. Thanks.
Thanks, Tommaso. And you were emphasizing the importance of the first or last mile, if you will, the domestic payment system. So how would you measure success in fast payments adoption, Sabine, particularly in smaller jurisdictions which might not have the volumes of hundreds of millions of transactions? So I think I heard earlier that you were referring to jurisdictions having access to fast payments, not necessarily operating their own fast payment system. But would you like to elaborate a bit more on how to kind of roll out fast payments, especially in smaller jurisdictions?
Sure. Maybe let me start from a macro perspective. If you remember earlier, I mentioned 21 live systems in Africa. These systems have produced 49 million transactions on IPSs in 2023. And this was about 47% growth versus 2022. These transactions in total value of transaction process is more than $1 trillion US. Now, accounting for the fact that we are even under evaluating because most of the 31 system, a lot of the 31 system, I think 10 did not provide the data. So that capacity is even much higher than we would think so. So, I would say a typical way of looking at adoption can be transaction performance data. But us at African Enda Foundation, we actually measure adoption from a different lens. We're really interested by inclusivity. Are these instant payment systems inclusive? Are they enabling vulnerable population, unbanked population to come into the formal finance population and have access to financial services? So when we're looking at it from an inclusivity lens, what we've brought up is what we call an inclusivity spectrum for instant payment system. And the way we're judging is quite simple, because at the most basic level, we feel that an instant payment system has at least to mimic what you do with cash. You can give money to somebody, or you can buy something. So person-to-person transaction, person-to-merchant transactions are enabled. That's very basic. Where we are looking at moving the ecosystem is toward the second and third tier. In the second tier, where we call it progressed inclusivity, it's really where you have private sector and public sector working together. You have competition between banks and non-banks to provide the best service to consumers. You have interoperability into this ecosystem, and you have the central bank, the regulator, driving inclusive governance of the system, mitigating private sector and public interests so that we are really providing services to consumers and we are enabling financial inclusion. So it's like when you're looking at it from an inclusivity perspective, the more inclusive the IPS, the better outcome for citizens, businesses, and government, regardless of the size of the country. And that is the measure that we are focusing on, because that's what will accelerate financial inclusion, and that's what will accelerate the digital transformation in Africa that leaves no one behind. Now, with that said, regulators in the driving seat means a lot of things. And when we're looking at it from a cross-border perspective, a couple of things I want to bring up. We talked about interoperability. Out of the 31 systems that are live in Africa, only 14 are interoperable all to all, meaning that they are offering optimum convenience to consumer, regardless of where I am in the country, regardless of which type of account I have, and regardless of which provider I hold my account with. I am able, with the most basic phone, to interact with the entire financial ecosystem, transact money wallet to wallet, wallet to bank, bank to wallet, and vice versa. And that is one side of the ecosystem in terms of looking at how we enable that interoperability cross-border. The other side, I think we mentioned earlier, talking about messaging. Out of these 31 systems, only 12 are actually compliant with ISO 20022. So what that says in terms of setting ourselves as domestically, as Tommaso said, for cross-border interconnection of these instant payment systems, there are definitely a lot of opportunities to do so. But this can't happen because most of the time when we interview the supply side, the providers, the biggest challenge is actually not technology, it's regulatory. It's the enabling environment in which they are doing business. So there's opportunity to solve these questions, both at the country level, regional level, and Pan-African. At the country level, if regulators are able to really level the playing field to enable both bank and non-banks to compete, that already brings competition, and that already has an impact of driving costs down for consumers. At a regional level, there's an opportunity for either mutual understanding of each other's regulatory framework or harmonization of these regulatory framework to enable private sector fintechs in one country to move to another country seamlessly. So thinking about licensing of fintechs and passporting of these licenses across one country or the other within a context of a region, whether it's SADC or other regions, that also has the capacity to accelerate our opportunity to offer, cross-border payments. And last but not least, I think at the regional, at the Pan-African level, there's a great opportunity for regulators and central banks to drive regulatory harmonization agenda for payment services. And why not bring a payment service directive for Africa that will really set the stage for all banks and non-banks in the continent to compete and provide cross-border payments that will really help drive the roadmap agenda for the G20 in Africa. I think for me, the call is to the regulators to lead the way and enable us in the private sector to compete for the share of wallet of consumers. And for that perspective, we at African and we remain ready to support this agenda, and I hope that you will call on us.
So inclusivity is an important point you mentioned, and let's do a very quick, fast round because we want to leave a couple of minutes for questions. But let's start with Tommaso, kind of coming from the kind of infrastructure level now to the end user. So what, in your view, would be a key area we should prioritize if you would need to choose one to enhance availability of safe, efficient, digital, and to cite Sabine, inclusive cross-border payment options for the end users?
So thanks. What does the end user really want? In a way, I don't know, and I don't think I should know. In a way, we should ask, and I very much agree, we should ask the private sector, which is closest to end users, to figure that one out. But not without a role for the public sector. In a way, I'm very encouraged by what I see in Brazil, in PIX, costs having come down to 0.22%, down from 2.2 using credit cards. I'm very encouraged by the Singapore-Thailand link, where the costs have come down from 13% to 3%, from 3 days to 3 seconds. I'm very encouraged by what I see in India. UPI transactions, 90% of transactions going through third-party wallets designed by technology companies, not by banks. So in a way, these are stories that highlight the success of the private sector, but also of the public sector. There's an important role here from the public sector, and I think this role has 6 facets, which I'll go through very fast. The first is infrastructure. Safety, settlement, interoperability, key to all these examples. The second is onboarding non-banks. They're the ones who have proven to be most innovative and closest to end users through open banking regulations. The third is standards around APIs. These are the connections between the non-banks and the banks, as well as QR codes, so that merchants don't have to have a tapestry of codes on their windows. Just one will suffice. The fourth is incentives for private sector participation. We need to think about that. How can we provide data to some of the providers in order to incentivize them to get into the market? Fifth is education. I think it's a very important role here. Banks initially resist joining fast payment systems. They think they will lose profits. And only slowly they learn that they can make money. Lower cash handling costs, better data, cross-selling of services to users. If we can make those examples popular around the world, public sector will face less restrictions from the private sector to roll out infrastructure. And finally, utilities. There is, and this is a question, there may be a role for the public sector to provide fraud detection utilities, for instance, we were speaking about this earlier, to the private sector in order to bring down the costs of payments. So public-private partnership, I think, is the way to solve the problem.
You framed it as public-private partnership with 6 elements, so I think you have a lot of points here to address. That's great. Sabine, you mentioned regulation. Anything else you want to add on top of that?
I was going to say to Thomas, I'm happy I'm sitting next to you because I can tell you what the consumer wants. For the last 30 years, I've lived in 6 countries, in 3 continents, and every single place where I go, I'm always trying to send money to my mother who lives in Burkina Faso. So I can tell you, ability to send money anywhere, anytime, anyhow. And if you're able to solve that for the consumer at instant, safely, reliable, and affordable, you win the consumer. And we all have the opportunity to bring billions of dollars in the remittance industry flowing in Africa to the formal finance, which will have replication for not only financial inclusion, but socio-economic empowerment of individuals and, of course, governments and businesses flourishing. So that's what the consumer wants. And the question, which I always bring to the floor, is what can regulators do to accelerate the pathway for private sector to provide these solutions? Because at the end of the day, this is what we can do. So hopefully that answers your question.
Thank you very much. Brendan, something to add from your side?
Yeah, I mean, I think it's clear what consumers want. And again, it's price, safety, and speed. And of course, transparency, those key indicators. And for us at Finmark, our approach is always a demand-side approach to it. Whatever we put in place, and again, I raise the red flags around CMA, the regulation that is increasing prices instead of decreasing it. That should be the measure of the success of any of these systems. Just to say, in terms of, from a SADC perspective, some of the other transparency also has come a long way. Again, non-banks are faring a lot better than banks in transparency. In terms of speed, most non-banks have got their speed down to under 1 hour. Your family can collect the money within an hour after you've sent it. Of course, again, Maxine, please don't hate me for this, but the banks cannot compete with that speed. At the moment, they are not able to compete with that speed. So I think the issues are clear in terms of what consumers want. I think the job is clear in terms of what we need to be doing. I'm referring to this corridor. I can't generalize for any other corridor. Thanks.
Thanks so much. Maxine, you have the last word.
Brendan. Success for me, Thomas, would be ensuring that, I think it's in all the work that each of us is doing. is to see the man on the street at some point in time being able to use the services that should be available. So whether it's the banks providing that service and or the fintechs or MTOs providing that service, there is a great opportunity. And we see it in the numbers. I mean, just one of the banks on the TCIB has been actually the greatest contributor on the facility. And that's why we're comfortable to tell you that over 300 million rand to date has been processed. And they joined not so long ago. So there is an opportunity, I believe. Both facilities, whether it's the SADC RTGS and or the TCIB, will provide you that safety, interoperable, speed, everything. But I think the aim really is for us to be able to provide a service to the man in the street, whether it's in the village or in the city. At some point, there shouldn't be that friction. We should, whether you're sitting in the city, whether you're sitting in the village, allow that person to receive money, whether it's digitally or cash, because cash has its uses in different places. But let's receive the money. Thank you.
Thank you very much. So now the challenge, we have 2.5 minutes left. So I'd say 2 quick questions if you want to get an answer to that questions. Arif.
Thank you for a very energetic panel and quite inspirational. A quick question. Do you think consumers want stable coins?
I'll field another question so you can think about that one. Any other question?
Just building on the pretty much similar question on the technological advancements, stable coins, tokenization. There are a lot of new acronyms are thrown every now and then, but how do you see that changing the field, the playing field for cross-border payment in the future, and what kind of measurable incremental value you would see that bringing to, not today, but advancing or upgrading RTGS, and what kind of monitoring or oversight that could be implemented to detect and prevent financial crimes, ML or fraud and other kind of crimes.
Thank you very much. Anyone?
My short answer, and I'm not an expert in this area, is that I'm not sure the consumer cares whether it's a stable coin and how they get it. I think the issue is, does it make the process more efficient and does it make it cheaper? So for me, those are the issues. I think there's a big hurdle to climb in terms of monitoring and ensuring that there's that it's not abused for whatever other crimes. I think that's a big hurdle that has to be climbed in the region, and I'm sure globally. But as I said, I'm not an expert.
I appreciate your answer, because one of the things I was going to tell you is that the consumer doesn't care what it is. They just want to send money from one point to another, and they want to be able to do it in an instant and have instant confirmation that that money has gone to whomever they wanted the money to receive, and they can do that affordably and simply. However, though, in the back end of the process and the technology, I think there's great promise in terms of how tokenization and leveraging digital assets can play in moving value of transfer. And of course, even if you're looking at it from a CBDC perspective, particularly in enabling, cross-border payment from the back end, from the gross value, I think there are opportunities. And of course, when you're talking about risk, I think we are in an ecosystem. Nothing is risk-free. Always going to be risk. I think there's a lot of collaboration I'm seeing in terms of understanding better risk and also mapping risk at a country level or regional level, and being able to have, I think somebody mentioned a utility on risk and fraud management earlier, on even enabling open source to leverage in terms of risk and fraud and mapping, and sharing that with the ecosystem so that our systems become smarter, and as we move forward we share more information on fraud. I think the jury's out to see how stablecoins and other digital assets are going to play in that ecosystem. But I do believe that technology has a unique opportunity to always ease the transaction pain. The front end, the regulatory environment, remains to be seen how central banks are going to assess digital assets or virtual assets providers, for that matter.
Thank you very much. And I think we have a topic for another panel, so I'm afraid we have to bring it to an end, looking at the clock itself. So I think what we have learned is that transforming global payments is not something that happens overnight. I think that is akin to steering a large ship that requires time and precision to change direction. The course has been set as the governor has laid out, and the ship has already started to move in the right direction, as highlighted also in today's panel. So the insights that we have heard today, I think, form an excellent basis for the conference that we'll have also later this year. And with that, please join me in thanking our panelists, and let me now hand back the floor to Deputy Governor Kassim.
Thank you very much. We're going to be very efficient with time. We have a fantastic dinner waiting for us in an hour's time. So let's move on straight to the next session. So many of you know that Governor Fabio Panetta is chair of the CPMI and co-chair of the CPC. Unfortunately, he couldn't join us, so we're going to display a quick video of a message from him and then move immediately to the next panel.
Governors, distinguished speakers, colleagues, good afternoon. It is a pleasure to address you today, and I wish I could be there with you in beautiful South Africa. I would like to thank the G20 presidency for inviting the CPMI, the Committee on Payments and Market Infrastructures, which I chair, to contribute to this significant event. On the eve of Mandela Day, we are reminded of the values Nelson Mandela stood for: equity, inclusion, collaboration, and progress. These values provide a powerful source of inspiration for our work on payments. Cross-border payments are vital for connecting people, businesses, and economies. They enable the flow of value across borders, fostering trade and financial inclusion, ultimately supporting the global economy. Yet, persistent frictions continue to hinder their full potential. High costs, slow transaction speed, limited accessibility, and a lack of transparency are well-known issues. These challenges are particularly pronounced in specific regions, corridors, and payment segments. In particular, cross-border payments within and to sub-Saharan Africa are among the most expensive and slowest across the globe. These challenges have significant social relevance as they disproportionately impact migrant workers sending remittances to support their families, small businesses striving to engage in regional trade, and communities seeking greater access to economic opportunities. Lowering costs for remittances in Africa is therefore a critical priority, not only for the individuals and families relying on them, but also from a macroeconomic perspective. While remittances may represent a small share of global financial activity, their impact in Africa is substantial. International remittances account for more than 3% of the continent's GDP, a figure that has almost doubled in the past 20 years. In 2023, all African nations combined received almost $90 billion in remittances. For some countries, they can even account for over 20% of GDP. Yet, remittance costs remain extraordinarily high. Particularly if they are initiated in cash, fees often reach double-digit percentages of the transfer value. When people have to pay more than $20 for a $200 remittance, it is unsurprising that they seek alternative channels, often informal ones. This is further fueled by lack of access to digital payments and limited financial education. Africa has the highest prevalence of informal transfers among all emerging markets and developing regions. In certain corridors, informal transfers may almost match those made through formal channels. This presents a clear business opportunity for new entrants to provide safer and more efficient payment options. By lowering fees, particularly for small value transfers, payment service providers can encourage remitters to shift from informal to formal channels. Given these realities, sub-Saharan Africa stands to gain significantly from progress towards the G20 goals of improving cross-border payments. Addressing these challenges would not only lower costs and reduce delays, but also unlock economic opportunities, foster financial inclusion, and improve livelihoods across the region. However, cross-border payments should not be seen in isolation. To truly support trade and economic growth, jurisdictions must also make domestic payment systems more efficient and secure, as they are the crucial first and last mile of both retail and wholesale cross-border transactions. Key actions include upgrading real-time gross settlement systems, extending their operating hours, expanding access, rolling out 24/7 retail fast payment systems, and migrating to international messaging standards, such as the ISO 20022. These measures are not only foundational to improving cross-border payments, but also are key to future-proofing domestic payment landscapes. The solutions are within our reach. We have the technology to align payments with the needs of a modern economy in an interconnected world. However, technology alone is not enough. Trust and transparency are equally essential. Advancing in these areas requires strong and constructive collaboration between the public and the private sectors. The CPMI is fully committed to supporting the South African G20 presidency in making progress in these areas. Our ongoing efforts focus on harmonizing payments, pre-validation, and confirmation of payee solutions, which aim to enhance the efficiency and safety of cross-border payments by minimizing operational errors and reducing the risk of payment fraud. In parallel, we have prioritized the collection of new data sources and insights. Granular, timely, and accessible data are the foundation for identifying frictions, supporting targeted interventions, measuring progress, and enabling informed decision-making. Reliable data and information not only foster accountability, but also help build trust among all stakeholders. Later this year, we will host a joint conference with the South African G20 presidency to examine these insights. Our goal is to analyze the unique challenges faced by different regions and guide our efforts to create more efficient and inclusive systems. Enhancing the safety and efficiency of cross-border payments is no small task, but it is a necessary one. By working together, we can transform cross-border payments from a barrier into a unifier that connects people, economies, and opportunities. As Nelson Mandela wisely said, it always seems impossible until it is done. Let us work towards a future where cross-border payments unlock opportunity and financial inclusion for all. Thank you for your attention.
Thank you very much. Can the panel members come on? I'm not going to say much, except that Governor Panetta set the scene. We're going to explore a deeper conversation here, particularly looking at interoperability between domestic and regional payment systems. And our chair is Arif Ismail, who is the newly appointed head of the payments department at the SAB and was previously with Tommaso at the IMF. Thank you.
Thank you so much. I hope you can hear me. Not yet? Ah, now I can hear me. Fantastic. I'm also cautioned that I'm between you and some very beautiful dinner and some Durban curry, is what I'm told that you're going to get to. So without further ado, I'm going to start off with a few opening remarks. I wasn't sure, Marcelo, whether I should do this because it was so well covered by the previous panel. But I must say, Sabine, I'm inspired by some of the thoughts, so I'm going to go through the opening remarks, but I promise I will try to keep it as short as possible. So good afternoon, everyone. I'm very delighted to welcome you to this panel on accelerating cross-border payments, a challenge that sits at the intersection of policy, infrastructure, and people's daily lives. I want to start courageously, though, with a humble vision and a dream that I think has started with the Saudi presidency, and a dream then that I know that you will share. I have a vision, I have a dream of a world, as you put it, where sending money across borders is as seamless as sending a text. Where a mother in Malawi can pay for school fees in Mozambique in seconds. Where a small trader in Tanzania can buy goods from South Africa without worrying, as Brendan put it, about hidden fees, delays, or even fraud. Where innovation serves not a few, but the many. And where trust flows, as Governor Panetta put it, as freely as the payments themselves. But today, we are not there yet. For many, cross-border payments remain too expensive, too slow, and too fragmented, especially in places like sub-Saharan Africa, where the promise of fast, inclusive payments is crucial for both financial inclusion and trade integration. So why, despite years of effort, are we still struggling with fragmentation? First, there's regulatory divergence. Each country has its own compliance requirements, KYC, data rules, forex restrictions, and these differences add cost and complexity for providers and users alike. Second, and I'm sure Avia is going to agree with this, I think, we face a lack of harmonized technical standards. Systems speak different languages. Some are real-time, some are not. Some use ISO 20022, others legacy formats. Without alignment, interoperability stays out of reach. Third, and probably provocatively, many retail payment systems are still closed-loop or bilateral. Proprietary rails dominate, and participation in multilateral systems is still an exception rather than the norm. And finally, there's a deeper issue of trust. Not just between users and platforms, but from geopolitical tensions between countries. When trust is fragmented, systems fragment. What this panel brings together is a range of voices on these particular issues, from standard setters to regional operators who are shaping how we solve this. So let's dive in. We have the following panelists, and very delighted to have you. Elisa de Andra Madrazo is the president of the Financial Action Task Force. Pleasure to have you with us. Elisa has over a decade of experience in leadership positions on AML, CFT, and so on. Javier Perez Tasso is the chief executive of SWIFT, an organization that he's worked for since 1995, and I know Javier has been instrumental in driving SWIFT's focus on cross-border payments. Juliette, my sister, I used to park next to her at Baza. Karuki is the managing director of FinSys. She has a passion for seeing inclusion and interoperability across Africa. My brother, Stephen Linnell, is the chief executive of Bank South Africa, and we're doing some fantastic work both domestically and in the cross-border space. Without further ado, we're going to put 2 questions to the panel. The first one's going to be about fragmentation, and the second one on trust. So let me start on fragmentation and interoperability, Elisa, and turn to you and say, FATF recently adopted revisions to its rules on payment transparency. How do those changes deal with interoperability and friction, including for sub-Saharan Africa? Thank you.
Thank you very much for the invitation. I see a couple of colleagues that are standing and their seats here in the front, so that will be left now. So the story of how the FATF just updated Recommendation 16 on payment transparency cannot be explained without the push of the G20. It was the G20 that mandated or asked the FATF to contribute to making sure the payments, the cross-border payments, were not only accessible and cheaper and faster, but also secure, and to contribute with that in mind in mixing the agendas. So the journey took over 2 years, and the FATF really engaged with the private sector, with experts of the payment system, but also the financial inclusion area and of technology, and a lot of the words and the voices at that table were represented from people here. So it was really a collective effort. Now, the story of this update is that for over 2 decades, we hadn't touched that standard. So it was over 20 years in which the system evolved. Of course, new players, new business models, yet the same standard from the FATF. And that created friction at many levels. First, in terms of having the clarity of who was responsible on collecting the information, which kind of information, how to transmit it, how to make it interoperable. So this is going to be a major shift by having that clarity from the standard of the FATF. This standard, it's also important because back in the day, 20 years ago, it was traditional actors. And now we have heard very clearly from the past panel how relevant or irrelevant banks are and new players are in cross-border payments. So all of these changes really bring clarity that will reverse the lack of harmony, the lack of interoperability in the system. It will be a cascade effect. The FATF sets a standard. The standard goes into the jurisdictions to be implemented through laws and regulation, and then it cascades into the private sector and, of course, the consumer. We expect that to take 5 years, so the deadline that we have for jurisdictions to be assessed on complying with this standard all the way down the chain is of 5 years, and, of course, this has to do with the challenges that it will take to implement it. And I'll leave it there, and I can come back on other aspects of this work.
Thank you so much. So the important takeout is that this change has been in the making, but what it does is it provides clarity and it provides a level playing field. Fantastic. Let me change tact, Javier, and say, can you provide, again at the global level, additional context on global fragmentation and a view on improving interoperability as it feeds into the regions and countries?
Very good. Well, thank you, Arif, and Governor, for the invitation as well, and for the panel. Great introduction, by the way, Arif. Well, from our perspective, maybe in terms of the market context, a couple of major trends that are actually converging in financial services, and indeed are impacting fragmentation. Because we see financial fragmentation increasing as geopolitics and shifting trade relationships are kind of recalibrating decades of globalization. Geopolitics, in fact, that have knock-on effects on infrastructure, and we see where today sanctions and other economic pressure tactics are short-term policy actions that have longer-term reactions. And we see, indeed, many countries around the world that are having as their top priority a strategic focus on sovereignty of financial infrastructure, data, technology, and we observe a shift towards regional groupings, bilateral relationships, and also a desire to grow the usage of local currency. So that in one hand, and in another hand, obviously, I mean, we've seen it, we heard it in the panel earlier as well, there is a huge wave towards innovation in the financial services industry. Been here indeed. Thank you for reminding me that I've been 30 years in the industry. It shows my age. But indeed, it's unprecedented, the amount of innovation, particularly in the last decade, and definitely accelerating when it comes to both actually the public sector, you know, like the G20, Tommaso was talking about, the G20 roadmap towards improving international payments in speed, cost, transparency, choice, and access, but also the private sector with banks, fintechs, new entrants, building up new business models, experimenting with new technologies like DLT, but also bringing up new forms of value. Mentioned in the panel earlier, we can come back to that, around digital currencies, stable coins, digital assets, tokenized deposits, and so forth. So all of this growth and acceleration of innovation, in a sense, obviously has massive positives in terms of customer experience, but it also, combined with the first trend, can accelerate this fragmentation even further by the creation of digital islands or regional groupings across the world. And that is, you know, we commissioned a study with The Economist that basically came up with a worst case scenario that fragmentation by the end of the decade can have an impact on 6% of the GDP for the world, so $7 trillion or something. So that's why, we'll talk for sure later about it, but obviously there's going to be new ways, more ways to move value, more business models, new technologies, but it's paramount that we build interoperability from the outset with the right foundations. We talked about it as well in terms of risks and controls, regulatory compliance, cyber, and so forth, to navigate the new world post the decades of globalization and make sure that we bridge all of this together and navigate that further.
Fantastic. So two things that I take out of here. The one is it's quite clear, including from the previous panel, that there's significant innovation that's happening at all fronts. But I think what you're cautioning is, as you captured it, short-term policy actions that may limit interoperability. And what you're guiding is we should be careful of creating digital islands, because the impact of that, as has been done by the study that you mentioned, is 6% potentially to GDP. So, and your plea is that interoperability must be baked into the design and must be thought of right at the forefront. So thank you for providing that context. Let me use that as a means to bring in my sister's voice, Juliet, okay, that says you've had lots of experience in the African continent, and what are the lessons that you see coming out, including potentially from Nexus and anything on ISO 20022 harmonization?
Thank you very much for the opportunity to the South African Reserve Bank for giving us a platform to share our experiences. FinSys is a company that was established by a former governor of a central bank, the late Professor Ben Ondulu from Tanzania, and he was very passionate about working to ensure that financial sector development on this continent happens in a manner that doesn't reverse the gains that have been made, particularly with respect to financial inclusion and the use of mobile platforms to be able to reach those who are excluded and underserved. Our focus has been slightly different the last 5 years. He's no longer with us, but we chose to implement this project, and we appreciate the support that we got from the coalition of early believers, including Governor Kganyago. Thank you very much. We were looking more at continental trade and the new focus on the African continental free trade area. and looking at how all the developments with respect to mobile payments, payment systems at large, could complement these efforts. We were seeking to draw lessons from the TCIB experience, and we really were trying to see how, through rationalized efforts, you could address the issue of variable geometries within the tripartite area. So the tripartite area comprises of 27 countries. There are 3 sub-regions within the tripartite area, namely COMESA, EAC, and SADC. And the challenge is that a number of countries have membership of more than just one region. And so the question becomes, how does all of this play out when it comes to cross-border payments? We felt at the beginning that the easiest approach would be the one that had less friction, which is to establish a hub and spoke model. So in other words, you have one single multi-currency retail payment scheme that all regions could plug into. But after engaging with more than 90 institutions over 5 years and being in the trenches, we can confidently say there is limited appetite for that, very limited appetite for that. So if fragmentation is looked at in this context, we have seen that the best way to address it is to empower domestic ACHs and domestic schemes to be able to drive cross-border initiatives. There are advantages to doing that. One of them is because they have the ability to coordinate across telcos and across banks. In our part of the world, telcos cannot be undermined in any way. They're very powerful. And there have been statistics to show that they can account for up to 60% of the cost of a transaction, which they then would pass on to the customer. So irrespective of what financial services providers are trying to do to make cross-border payments more accessible, more affordable, if you don't get a grip on telcos, really you're in trouble. The other thing that we also saw was the potential strength of domestic schemes and domestic ACHs to manage the plethora of messaging standards that exist both in the non-bank environment as well as in the bank environment. So ISO 20022 is considered to be SWIFT bank language, so to speak, but there are many other standards that are out there, and the need to coordinate across to ensure that you derive the aspirations that the roadmap that G20 has promulgated, to derive those aspirations, there has to be strong coordination and, if need be, intervention to ensure that there is seamless integration. There are other strong benefits of working, and again, I'll bring the nexus issue into this, is domestic schemes, certainly those that are managed by central banks, is they have the ability to think through the implications of a parallel forex market that exists, that has to be factored in when you're looking at currency conversion issues. Where we are today is that there is an agreed approach between East Africa and SADC on how integration can happen in the retail space. What remains to happen now is to venture into the proof of concept phase, where other issues can be taken into consideration, including regulation, which is fairly complex, as well as standardization with respect to messaging standards. One final thing I will say, again, thanks to the support, and I must appreciate you here, Steve, at BankServe, but also the South African Reserve Bank, is what we realized is the real appetite in these 3 countries to connect to this part of the world stems for their interest in connecting to South African financial institutions. And that if TCIB at some stage could enable them to access a domestic scheme that has cross-border reach, then a lot of the challenges that we have identified could be addressed. So maybe I stop there.
Fantastic. Such a rich set of thoughts, Juliet, that it's easy to just skip on, but I'm just going to pause for a second because you used some really fantastic language. I'm just going to play it back for a second. So the first thing that I took out was this one silver bullet to one major platform that does it all for Africa. You're saying, be wary of that. That is likely not the way to go. That there's a power in the power of domestic schemes. And in fact, some of the dynamics that play out in the domestic environment, like parallel forex markets, is stuff that one needs to think about quite carefully. And you make the case for the power of ACHs and for connecting. But your belief is that this would not have happened without the coalition of early believers and early doers. So that's fantastic. And then you subtly pointed out that we often talk about a level playing field, but you said you must not let go of understanding or taking the hand of telcos. So these are fantastic points that you've raised, and I'm going to bring Stephen in and put him on the spot and say, Stephen, do you agree with Juliet? Are those points that resonate with you? And could you talk a little about TCIB and the work in the SADC domain? And would love to hear your views. Thank you.
Sure. Hello. Thank you, Arif. I can see by the order of your questions I sat in the wrong seat. I'd heard the hot seat was where Juliet is, so I changed, but apologies. So yeah, I think first off, with a SADC hat on, what is clear is that there is a need. This is not a solution looking for a problem. If we look at the 16 countries that form it, it is home to 400 million people. And as the governor mentioned earlier on today, it's also home to probably the world's collection of slowest and most expensive corridors. And this is in part, to Brendan's earlier point, because much of those transactions are sitting either in the informal sector or in closed-loop models. And whether you're in one or the other, for the most part, there's an endpoint sitting in cash. So if I was to orientate or preface the things that we need to do to get the SADC community moving fast, and a slight segue, I really appreciate the fact that this panel is following the climate disaster panel, because when we look at those SADC stats, it doesn't seem so bad anymore. But the things that we really want to focus on here is, particularly amongst the central banking community, is to get a coordinated response, not just in intent, but in execution too. As much as I fully agree with Juliet around the prominence of the local ACHs, the cohesion across these regions are critical, and that doesn't happen necessarily on an organic basis. So that coordination is key. I would have a strong bias for preferencing open access or open loop capabilities. I would have a strong bias for pushing regulatory harmonization, and this could be anything from simple elements such as balance of payments code harmonization all the way through to licensing regimes. And then lastly, and it touches something that the previous panel also mentioned, was around finding a mechanism to broaden access to the settlement layer of the ecosystem. And so that is really bringing non-banks into the mix. If we consider TCIB for a moment, it is fortunately designed on an ISO 20022 standard. It's an open loop scheme, and as you said, not the rule but the exception. It's also a multilateral capability. Right. But these things are really important to consider, because when we speak about hub and spoke or bilateral link or single access point or common platform, one does have to take the regional context into consideration. And in a SADC context, more than half of the countries that make up SADC do not have domestic faster payment schemes. Right. And even half of those are not on ISO standards. So you already sit on a very differentiated trajectory. And something like Nexus might certainly be the preferred alternative in a model where the regions are on parity. But where the region is on a very differentiated development course, like it is in SADC, it's important that the regional scheme is able to cater for each of those types of operating models. So that's really how TCIB is positioned. It is able to do direct bilateral links with other regions. It's able to do single access points. But I think the sweet spot will be when you have those domestic ACHs having an interoperable link through a regional scheme on a cross-border multi-currency basis. And that's really where we're working towards.
Thank you very much. I guess the thing that I take out is that the flexibility that you have in the model means that you have the capability, as you say, of interlinking with other faster payment systems. But for those who don't have faster payment systems, you can have single point connection to that. But there are four things that you raised that I thought was really, really interesting. The first one is just on the importance of strong coordination. Okay, and again, I'm going to put you on the spot and say, if you think of TCIB and you think of the struggles, the genuine struggles that we've had with coordination, okay, where do you think that strong coordination needs to come from?
Maybe there's two comments. I think there's been two challenges with TCIB adoption. And the first is probably not understanding where the need comes from first. So when we initiated it, we broadly opened participant access up to the full region, not thinking that the dominant corridor is from SA into other countries. And so we didn't focus on bringing in the domestic financial service providers in South Africa. And we can see, and Maxine spoke about it previously, the minute that you had a domestic large financial institution coming on board, you started getting this network effect building. And so that is what we've been doing over the last year, is pivoting back to the dominant initiating corridor and pushing outwards from there. So maybe that's just a side comment. In terms of the coordination, I think we are seeing very strong traction in the domestic markets where domestic central banks take a formative stance in the market. The link between domestic faster payments, economic velocity, and so GDP growth is clear. So it is a realm that the central bankers do play in. And then as a collective across the region, being able to lead that, particularly with the regulatory harmonization, is absolutely key.
So I'm going to break the protocol. And instead of jumping in, Tommaso, to the next theme, I've been told that some folks might not know what TCIB is. Transactions cleared on an immediate basis. I was told by the CEO of a bank, surely we can come up with easier names for these particular things.
When bankers play in marketing.
Absolutely, when bankers play in marketing. Can I, again, I'm sorry I'm putting you on the spot again, Stephen. Can you just say in 2 minutes, what is this TCIB? And to break the protocol, I'm just going to take two or three questions from the audience, just on interoperability, before we move on to trust, if that's okay. Please, Stephen. Yeah.
Sure. Thanks. I mean, just to re-echo some of the points, it is an open-loop regional scheme. So it is a set of rules that govern the interoperability of payment flows across border. It is based on ISO standards. It is a scheme that is run by the governors of the central banks of the SADC community, and it is a scheme that is operated by Bankserve Africa. And as you touched on earlier, it is deliberately set up so that it can have point-to-point connections where there's an accelerated activity. So if you take Zimbabwe and South Africa as the dominant corridor, that would be a key case in point where you might do a bilateral link. But we have much broader aspiration than just participating in SADC, and we want to connect to the other regions in Africa. And so being able to operate as a hub and spoke or a single access point loop is critical for that infrastructure. So really TCIB is a faster payment system at a regional level.
Yeah, thank you very much. So again, breaking the protocol, you can now put any question to our panelists. Sabine, is that Sabine? Yes. Please go for it.
You open the door. I'm taking the plunge.
I open the door. Please go for it.
I think what I would like to know is, as the panelists, what do you think the current live instant payment systems need to do to open themselves up to interlinking and interoperability at a Pan-African level? what are those requirements? Because there are 31 that are live already, including, of course, TCIB. What needs to happen at that level?
Right. So 31, what do we do to get them to interconnect? Can I start? Whoever volunteers, do you want to go for it?
I'm going to stay in the hot seat very quickly because we operate a domestic faster payment system, PayShap. And to answer your question, the first thing we did when we tried to interlink the domestic faster payment system with the regional one is we realized that despite the fact that they're both sitting on ISO 20022, the mechanism under which they embedded that are slightly different. And so just having a domestic faster payment system on ISO doesn't necessarily mean it will interconnect. So I think on the one hand, one should have interoperability embedded from the start. And there you need international frameworks and standards to drive that. The second thing is to accept that not everyone is on the same trajectory, and so that you might be approaching this after the fact. And there you need strength of will and coordination. It's around articulating clearly what the end goal of the cross-border transaction is. What is it enabling in your economy? And then having coordinated alignment, particularly through the central banking community into the private markets to enable it. Just from past experience.
Elisa, could I bring your voice in just from a FATF perspective? I'm assuming that if you've got all of these particular systems and you want to interconnect them, in terms of the recommendation that's come out, what would your expectations be? What would your guidance be? You did cast a vision that said, or a timeline that said, it's going to take some time. It's going to probably take about 5 years. Are there any additional thoughts that you have for the region?
So, for those that are not as familiar with the FATF, we have 40 members. The 20 G countries are part of the FATF, but we have a network of 200 jurisdictions that are part of the FATF global network and that get assessed and have committed to implement the standards. So when you think of the FATF standards, it's really global, and I think that's the power that we bring to the table. The interoperability that we're seeking, the fact that we're mandating using standardized data, mandating using the format of ISO 20022 will make a big change. So when you think of the 5 years, it's not that we have to start later on. We're starting now. The message is very clear. The guidance is there, and the step must be taken now for us to have a full change implemented in 5 years. Now, when you're setting a standard, you have to be cognizant that it's the base and that it has to be implemented everywhere. And that means jurisdictions that have lower capacities, bigger challenges, and other dynamics. And that's very relevant to the region of Africa, and in particular sub-Saharan Africa. We take the principle of doctors. We don't create damage by trying to do something good. So in this conversation, it was super important for us to have financial inclusion in mind and to have the idea of not pushing people, excluding people of the system. So important factors. If the transaction is below 1,000 euros or dollars, it does not have to comply with the requirements that we're asking for AML, CFT at the level of detail that are set for over $1,000. But that doesn't mean that all the financial institutions will be implementing the standards, and that will help even those transactions that are below $1,000 or euros in the interoperability. So you get the benefits, taking care of not excluding others of the system that really need it, for example, for remittances. And at the same time that we issued recommendation 16, we amended our recommendation on the risk-based approach and the proportional implementation of the standards to make sure that we don't put the same level of high-risk measures for low level of risk transactions. So the poor and the vulnerable, usually the products and services they use are not very sophisticated and don't really require enhanced due diligence, yet there is risk aversion, maybe increasing because of sanctions, maybe increasing by other reasons that we also see on the risking. But there is the overcompliance and the lack of risk appetite to go for simplified due diligence measures. So we're making it mandatory as of February of this year for countries to encourage the use of simplified due diligence measures when there is low risk. And we'll be assessing that. And we will not shy away from signaling when there is overcompliance and when the country is not asking their institutions and the private sector to look for simplified measures in low risk, because that's the risk-based approach. That's when you take the resources from low risk to the high risk. So it's a win-win. You put the resources where the risk is, but you lead others in the system. And that is fundamental for Africa. And that's how we are approaching this issue, holistically and taking responsibility, not only from a strict AML perspective, but making sure it's compatible with financial inclusion. That, by the way, goes hand in hand with financial integrity.
I want to almost stand and applaud, because I think that is really significant. And I wonder, as he smiles, I wonder how we make sure that this message that you don't need a regulatory bazooka for a mosquito set of transactions, how do we make sure that that is well understood, that it is well understood? It's a risk-based approach, and it's proportionate, and we should balance and trade off between financial inclusion and financial integrity. I get that. That's fantastic. Avia, can I bring your voice in? Are there any additional things that you could suggest as we think about interconnecting, etc.? You know, what's on SWIFT's mind?
Okay. Well, by the way, great answers, Elisa and Stephen, and I'm very pleased to hear so many times ISO 22222 without me having mentioned it. You know that it's probably our top priority for the last 15 years, and I'm very pleased to see, you know, the take up at the domestic level. And as you know, we have the end of the coexistence with the existing standards in the cross-border space as well, ending in November and progressing very well. So we are going to get, you know, as of the end of this year, with a first version of ISO 222 across the board, domestically and cross-border. Of course, a lot of work to be done still, but we should also, you know, as a community, take credit for that achievement. Maybe to add, net new. But maybe I would, from our perspective, you know, at SWIFT, the reason SWIFT exists is actually to interoperate payment systems. Well, we talk about payments, of course, but we've been not interoperating payment systems since the very beginning. Because, I mean, not every single, I mean, we connect 11,000 institutions, but there are tens of thousands, even hundreds of thousands financial institutions in the world. Not all of them are connected to SWIFT. Not all of the accounts are directly connected to SWIFT. However, the domestic payment systems, starting with ACHs, RTGSs, and of course now faster payment systems, there is at least one institution, obviously there are several in every market, that are connected to SWIFT and act as a relay into the domestic platforms. So that's how we reach 4 billion plus accounts in the world that can be actually interconnected almost instantly now going forward, and we can talk about stats, but we see 90% of the payments in the SWIFT network already reaching beneficiary banks within an hour, and those are conveyed further. And of course, if you integrate that with real-time payment systems, then we achieve the end game. So so with that in mind, our focus here is to make sure that the interbank leg, that the cross-border leg, meets the G20 targets when it comes to speed, transparency, cost and access. And we're well on the way to get there. And that's how we feel. It's almost like, and by the way, technology is the easy bit. I mean, there are many technologies, many initiatives that are popping up to interlink payment systems. I mean, operational resilience, compliance with regulatory requirements, data standards, and actually immutability of data standards across the board. All of those are much more critical, and of course having a global governance and global supervision of that system are much more complicated. So that's how we feel we can contribute to that end. But I do agree with both of you, Lisa and Stephen. You know, a lot of work needs to be done also on this harmonization, the last mile. And Tommaso, you were talking earlier about 80% or 90%. Well, 90%. From our end, we see 80% of the journey is at the receiving end. So of the speed of a transaction. So indeed, a lot of work needs to be done at the harmonization of standards, compliance practices, 24/7 working hours, and so forth.
Thank you so much. The organizers are going to be very upset with me if I don't get to the second question and the second theme around trust. So let me change tact and we speak a little about trust. And I guess the first big question that I want to ask is, and maybe turning to you, Juliet, is what's the right strategy for building trust and, of course, combating fraud while still driving inclusivity and usability? What's your experience from the continent, Juliet?
Our experience to date, trust is important, but that in and of itself will not prevent users from making use of a particular scheme. I think what is really important is access to data. And I think as the continent seeks to integrate and trade more, greater emphasis needs to be placed on how to access this data. There are vast volumes of data out there that can be used to inform policy decisions and to support consumer education. And that is, brings me to the point I wanted to make about the role of third-party processors. They sit with a lot of cross-border data that could be of significant benefit to domestic ACH operators, domestic schemes. And so trust begins with information. But what we've also realized is that in our roadmaps that we develop to support integration between two schemes, the trust factor is normally delegated again to the respective central bank in a country. They are better placed and better positioned to be able to ensure that trust is garnered and is understood by the users that they serve. Yeah. So data, I go back to that point, the ability to access data across board, the ability to bring in third-party processors who currently hoard a lot of data related to cross-border payments, and then importantly, leveraging of the strength of domestic regulators to push consumer education. Yeah.
Thank you so much. You underscore the point that trust begins with information, and I'm making the assumption naively that this is about payments data. Is that correct, or is it broader?
Yes, transactional data.
Transactional data.
Transactional data, yeah, very important.
Fantastic. Stephen, can I bring your voice in, and can you bring in some local examples, including thoughts on the confirmation of payee? How important is this for building trust?
Sure. So we've covered data as it pertains to the transaction itself, but trust is also formed in data with respect to the counterparty. And so it's very much that angle where something like confirmation of payee comes into play. But the way I like to think about it is, if we consider cash, which we've already said now dominates the SADC region at least, it is a bearer instrument. It really does not require an understanding of who the counterparty is to the transaction. Trust is embedded largely in the issuer.
Right.
That is very different to an electronic payments world where who you are paying is critical because it undermines or at least underlies things such as fraud that takes place. So I think the key takeaway, given that as a condition precedent, is that we should be building faster payment systems with pre-transaction validation steps such as confirmation of pay at the get-go. If we look at both PayShap, as I mentioned, as the domestic faster payment system, it has had a proxy resolution service embedded from its start. We will go live with an account resolution service towards the end of this year. Both of those are effectively a confirmation of payee. On TCIB, that has a confirmation of payee. And I think we've learned really from looking at the UK, who was an early adopter of mandatory COP. I think Europe is going live later this year. Australia has just gone live. And I think particularly on faster payments that are push payments, push payment fraud is material in the markets where they have scaled. And so something like a confirmation of payee embedded, if not mandatory in most transactions, is necessary to build trust in the ecosystem.
Absolutely. We've got about 6 minutes. If it's okay with the panel, I want to turn it over to you. I think you've heard two fantastic panels, and we've got about 5-6 minutes. Let's open it up to some questions from the floor. Who could I prompt?
Stable coins.
Stable coins. Stable coins. Please, Sabine. Yeah.
Thank you so much for this opportunity. This is a great discussions. I really want to ask the panel, what is the challenge in terms of regulatory harmonization to enable seamless cross-border payments in Africa? Why aren't we there yet?
Right, right. Who would like to take it first? Javier? Yep.
Okay. I would say, so I will take the global perspective. So it's clear that the lack of harmonization of compliance practices clearly is, and it's been highlighted, by the way. I will not redo the work that the G20 has done on all the building blocks and focus areas, but those, from a regulatory perspective, are key in terms of addressing one of the challenges, which is, we've talked about it at length, the last mile reaching the beneficiary accounts. But more generally, also, I would add the fact that there is an opportunity to leverage everything that we've built. The strength of what we've built in terms of infrastructure over the past decades, when it comes to financial messaging systems that are fully integrated with the highest levels of security, resilience, cyber security, and fraud detection capabilities. But in addition, within the regulated environment, and those capabilities, there is still a lot of potential in those capabilities to achieve the levels of speed, transparency, and cost that are required and are very well expressed in the G20 targets. And there, I don't know if it is a regulatory ask, because that's your question, but more generally, I think it's an industry ask, because it is our responsibility as an industry not to start from scratch or not to throw the baby with the bathwater, as they say, but make sure that we leverage all of this strength that we've built in terms of controls and take it to the next level in terms of speed and transparency for the end customer. And that would require, indeed, in the chain, a few changes when it comes to the rules of these cross-border transfer payments to be settled. We may talk about the scheme, and this is definitely something that we are considering at SWIFT.
Thank you very much. Does anyone else want to react? I see there's a question from Marcelo. Doesn't look like it. Go for it, Marcelo. Yep.
Yeah. Thanks. You're talking about trust. Trust is hard to conquer, hard to sustain, easy to lose. There's a reflection. It's a dynamic concept.
Yep, absolutely. Absolutely. Agree with you. My mom used to say this all the time, Marcelo, that it takes a lifetime sometimes to build trust and only an instant to destroy it. So fully agree with you. One more question, and then we depart to dinner. One more question. Please, Nomolazi. Thank you.
Yes, thank you, Arif. So my question would be currency conversions. We have 54 countries in Africa and 54 currencies. How would we handle that in a more transparent way, because it does play itself in the cost as well?
Thank you. Currency conversions. Who would like to pick up on this one? No volunteers.
I think I think she's angling for the stablecoin question.
I see.
Talk about stablecoins, right? Yeah. Elisa wants to say something as well.
Elisa wants to say something.
So stablecoins. This is a very relevant topic, and actually the FATF back in 2014 recognized the risks of virtual assets in general, and in 2018 we were the first ones to define what it was, what the risk was, and to set regulation and supervision. So I think that it's very important when you think about the transactions to think that stablecoins, at least from an AML-CFT perspective, it's not an unregulated area. We have standards, we have regulation, and we issue every year a document that reports on how countries are doing with this. And we will start assessing countries in this new round as of this year. As of today, the report of last month showed that 85% of the stablecoins market and virtual assets market is under regulation and supervision, or at least in the midst of being regulated and supervised. So from a material perspective, that's very good news. The bad news is that unless you have everyone covered, you have safe havens. So I just wanted to put in the pitch from the FATF that it's not something that it's out of our scope, to say the least.
On stablecoins, in the previous panel, we were talking about do the man or woman in the street need a stablecoin? The thing is, and I do fully agree, Lisa. The thing is that we need to differentiate the customer credit transfer and the transaction with the settlement layer, and indeed there is potential in the settlement layer to improve it to new levels, and clearly stablecoins, tokenized deposits do have that potential, but this needs to be supplemented with a messaging layer that allows for achieving all the controls when it comes to AML, CFT, KYC, and so forth. And because those are not necessarily embedded in light content at the level of the DLT of the platform that transports stablecoins. So that would be my add there. So yes, they can definitely coexist, but they need to be supplemented with the right data levels that build on a particular scheme that conveys those standards in line, again, with the G20 objectives. Whether this is done on fiat settlement or stablecoin, at the end, it's the best and most optimal channel that will be used.
Stephen, you wanted to come in? Or?
Final comment was just around whether there's actually a need for it. I think there's not a need for it in amongst itself. The need for the stablecoin is largely because there are increasingly a number of assets that are being tokenized, particularly private assets, where there's a demand for it. And a stablecoin is an effective on-bridge mechanism onto a DLT, as Javier mentioned. So the desire for the stablecoin is really just an on-ramp asset for the desired assets sitting on the chain. So without those assets, there's no demand for the stablecoin.
Thank you so much. I have the easiest task in the world to thank the panel profusely for the diverse set of thoughts and really insights that you've shared. On behalf of Governor and Deputy Governor Kassim, I also want to bring the session to a closure and invite you towards dinner. Okay, thank you very much.